Welcome to the Deep Dive. Today, we're jumping into a summary of a really transformative book. It's called The Win-Win Wealth Strategy, and it's by Tom Wheelwright, a CPA.
Right. And the core idea here is that it unveils these seven, government-subsidized investments.
Exactly. Ways to transform your taxes into a powerful wealth-building ally, not an enemy.
I mean, if you're struggling with high taxes draining your earnings, this book really lays out some actionable plans.
Yeah, for business, for real estate, retirement, and really boosts your net worth.
There's even this idea of, picturing the government helping to pay for your dream car. It sounds crazy, but...
But there are real solutions in here for, I guess, everyday financial problems. So let's find out more.
Okay, so let's try to synthesize the premise here, because it really does fundamentally flip the script on how most of us think about taxes.
It does. We're all conditioned to see the tax code as this, this burden.
A set of rules just designed to take your money. But this book argues the complete opposite. Right. And we need to be clear, we are not talking about stumbling across some unintended loophole.
No, not at all. Those are just, like, accidents from bad legislative writing.
This is about intentional incentives. Deliberate policy decisions that governments around the world have designed to encourage very specific, socially beneficial behavior.
It's a total paradigm shift.
Yeah.
Especially if you're someone who feels just, completely overwhelmed by taxes.
Yeah.
It moves the conversation from just compliance to actual strategy.
And I think what's so fascinating here, and what really grounds this whole approach in credibility, is the source's authority.
Tom Wheelwright.
Yeah. I mean, he built his career creating these innovative tax and wealth strategies for, very sophisticated investors and business owners for over 40 years.
He wasn't just doing taxes for a small shop.
Not at all. He spent 3 years in the National Tax Department of Ernst & Young. That's one of the biggest accounting firms in the world. And he was an adjunct professor in the Masters of Tax program at Arizona State for 14 years. So his experience advising these huge companies shows how you can pay, and I'm quoting, little to nothing in taxes legally.
Right, just like we hear about major companies like Amazon or Tesla doing.
Exactly. So this deep dive is really about understanding the actual mechanisms they use in the real world.
So I guess the central mission for us today then is to understand how you move from being a silent partner with the government and actively become an active partner.
And the silent partner is the typical employee, right? Or the small business owner who just pays the highest effective tax rate they possibly can.
Oh, yeah. Often, north of 40% when you add it all up? Local, state, federal, FICA?
All of it. We've all had that feeling. It's like that great line from Rachel in Friends when she gets her first paycheck.
Huh, yeah. Who's FICA? And why is it getting all my money?
Exactly. But the government isn't necessarily trying to punish you. They're just offering two paths.
The high tax path for people who just earn a wage.
And the incentivized low tax path for people who go out and solve the problems society has.
Right.
So the tax code, the way Wheelwright frames it, it's not a punishment. It's a clear, deliberate mechanism.
Yeah.
It's basically a roadmap for building and protecting your wealth, but only if you understand how the incentives actually work.
So our focus today is really twofold.
First, we have to grasp the philosophy behind this win-win strategy, the why behind the tax breaks.
And then second, we'll explore the first three big investment categories that governments everywhere incentivize.
Right. Business, technology and R&D, and real estate.
And the idea is to arm you, the listener, with the insights you need to ask much better questions of your own advisor.
Yeah, to shift your whole context from seeing tax policy as this necessary evil to seeing it as a really powerful tool for building wealth.
Okay, so before we get into the specifics, we have to kind of, recognize the battlefield here. The tax game.
A game that everyone is forced to play.
Everyone. Whether you do your own taxes on some software or you have a whole team of CPAs, you're in the game.
And being a silent partner, as we said, just means you're passively accepting the highest rate, which is, an immediate and self-imposed financial penalty.
Right. The average person starts at a huge disadvantage because they just don't have that sophisticated advice. Their silence is literally costing them a fortune.
Whereas the active partner, they recognize that tax breaks are not just some accidental gift from the government.
No.
They're an exchange. You get a tax break in exchange for taking on investment risks in activities the government has explicitly said are a priority.
And the government wants you to do this.
They desperately want you to do this because they want specific outcomes, more jobs, more housing, more innovation, and they know that transferring that financial risk to the private sector is the absolute cheapest and most efficient way to get it done.
So that brings us to the real goal of the game. which is it's not just about reducing your taxes this year.
No, it's much bigger than that. The goal is building wealth that will never be taxed.
And that is the key difference, isn't it? It's not about saving a few $1,000s in April. It's about creating generational tax-free wealth, all by playing within the government's own rule book.
Exactly. The government encourages this because the private market is just so much more efficient at achieving these big societal goals than, direct government spending could ever be.
I think that efficiency argument is maybe the most compelling part of this whole philosophy. It really reframes the discussion away from loopholes and toward, smart government policy. So why is the government willing to make this trade-off?
Well, it all comes down to one word: leverage.
Okay.
Governments understand that when they spend money directly, let's say the Treasury Department decides to build a public housing project or launch its own R&D project, they get a one-to-one return.
They spend $1, they get $1 worth of stuff.
Precisely. But if they use the tax code, they can engage in this highly leveraged incentivization. So by offering a tax credit or an incentive that costs the government, say, $1 in lost revenue, they can incentivize private capital to step in and spend $9 of its own money.
And suddenly you have $10 worth of societal benefit.
For a $1 cost to the government. This 1-to-9 leverage is incredibly smart public policy.
It really is.
They're getting $10 of value for the cost of $1. They're leveraging private companies to do their work for them at a fraction of the cost, and they're offloading almost all of the risk.
So they're basically saying,
look, we'll share in the expense and we'll take a share of the eventual profit through taxes. But you, the active partner, you take the risk, you manage the operation, you do all the hard work.
yeah.
It's an unbeatable deal for the government as long as the private sector delivers.
Okay, so to be a really sophisticated partner, you have to understand what the government's main goals are. And every single tax law, every deduction, every credit, it all connects back to these 5 universal goals that keep society stable.
This is their fundamental mandate.
Goal number 1, and you could argue it's the most important one, is to keep the peace.
And that's a huge concept. It's
Yeah.
not just about, police and law enforcement.
No, it's about preventing civil unrest, which almost always comes from people being unable to meet their basic needs: food, clothing, shelter, opportunity.
So the government accomplishes this mainly by encouraging job creation through the private sector. If you look at the numbers in the U.S., for example, 82% of all jobs come from large and small businesses.
And the government only provides 18%.
Right. And that disparity is why the incentive structure is so strong for business. Government jobs are actually the least efficient way to provide employment.
It's $1 in, $1 out. It's funded by existing taxes.
Exactly. But when the private market creates jobs, they generate new taxes from labor and from business profits. It creates this virtuous economic cycle. The private market is simply the most powerful engine for peace through prosperity. So tax incentives that spur hiring are the absolute bedrock of the entire code.
Okay, that makes sense. Moving on to goal number 2, protect the people, national defense.
And this one has evolved dramatically over the years.
Yeah, it's not just about tanks and planes anymore. It extends crucially to things like energy independence and cybersecurity.
And history gives us some pretty stark lessons here. I mean, the vulnerability of your energy supply dictated huge events in World War II.
Right. Japan's attack on Pearl Harbor was directly tied to the U.S. cutting off their oil supply.
And Germany's eventual loss was basically fueled by a lack of oil to keep their military machine running.
So in the modern era, physical defense and technological defense are completely linked.
Absolutely. That SolarWinds cyber attack back in 2020, which compromised critical government systems, it showed just how vulnerable our infrastructure is.
So incentivizing private R&D in energy, like solar or fracking, and insecure digital infrastructure is now a core defense strategy.
It is. The tax code is actively subsidizing tech companies because they're the ones building the modern defense shield that protects the economy itself.
Okay, goal number 3, feed the people. This one feels pretty self-explanatory.
It's non-negotiable. We saw how quickly things can fall apart when basic needs aren't met. I mean, the Arab Spring uprisings in the early 2010s, a lot of that was attributed to skyrocketing food prices.
So instability literally spreads from the dinner table.
It does. So even policies that seem unrelated, like tax credits for sustainable agriculture or incentives for energy-efficient farming equipment, they are fundamentally tied to ensuring a stable, low-cost food supply to maintain social harmony.
Governments are always thinking about the stability of that food supply chain.
Always. Which leads to goal 4, Shelter the people.
And this is one where governments have learned a hard lesson.
They really have. Globally, they've recognized the failure of these massive state-managed public housing projects. We see documented failures in Russia, Poland, the Czech Republic.
And tragically, in the poorly managed public housing in big cities like New York and the suburbs of Paris, they often became these concentrated areas of poverty and crime.
So the lesson learned is that private markets, if you incentivize them correctly, do a much better job of providing diverse, well-maintained housing.
So the tax system heavily incentivizes private investment to build, manage, and maintain housing.
It's a classic win-win. The tenant gets a place to live, the investor builds wealth, and the government doesn't have to deal with the failures of centralized management.
And finally, goal number 5, educate the people.
A strong, peaceful economy absolutely depends on a successful, upwardly mobile middle class, and that is fueled by education.
Right. The primary difference between a first world country and a developing one is often the level of educational opportunity.
For sure. And tax incentives play a huge role here, not just subsidizing schools, but encouraging private citizens to get higher levels of education through credits and deductions, which strengthens the future economy.
So those are the 5 big goals, and these policy incentives are the tools the government uses to meet them.
And we have to keep stressing this. These are not accidental loopholes. They are designed features. They're the government's menu of priorities where they're willing to share the cost with you.
And that menu has 7 core categories that governments everywhere consistently subsidize. Number 1 is business, which is all about jobs and production.
2 is technology and R&D for innovation and national security.
3 is real estate for shelter and economic stability.
4, energy, which ties back to national defense and peace.
5, agriculture for feeding the people.
6 is insurance for risk management and stability.
And 7 is retirement, which creates a stable populace that doesn't have to rely entirely on the state in their old age.
And today, we've decided to zero in on the first 3, business, tech, and real estate, because they just offer the most massive, accessible opportunities for everyday wealth creation.
If you're willing to become an active partner.
Exactly. Okay, let's start with the foundation, business. The government's primary goal for business is, without a doubt, job creation, innovation, and production.
The core message is simple. If you create a viable, growing business, the government will be your financial partner.
And Tom Wheelwright shares his own story about this, starting a CPA firm with the goal of building a company that people loved coming to work for. That ambition led to 50 employees and 3 offices. And the joy of being an entrepreneur is creating those well-paid, interesting jobs. The government is the biggest backer of that effort.
To bring back that cost efficiency point, the government loves private job creation because it's a leveraged return.
Mm-hmm. When we say government jobs are parasitical, we're talking purely in a financial context.
Right. The government pays the wage and then taxes that same dollar. It's a self-funded one-to-one cost.
But a private business creates taxes from the labor it hires and from the resulting business profits. So the government gets tax revenue from 3 streams: the employee's income, the employer's payroll taxes, and the business's profits.
Which makes private job creation just exponentially more cost-effective for the government's budget in the long run.
And that dynamic is why the core incentive for business is so universal. Money that you reinvest back into a business is deductible against your income.
It's an elegantly simple principle. If every dollar you spend is meant to produce more dollars in the future, buying equipment, hiring people, marketing, the government doesn't tax you on that initial spend.
That deductible money is tax-free until it actually generates a profit. And this applies in virtually every country, which confirms it's an intentional, universal policy to stimulate growth.
Now, obviously, to stop people from just writing off their personal life, the government applies some pretty rigorous tests for deduction.
Oh, yeah. They need to make sure the business activity is genuine. These are the 4 deduction tests, and you have to meet all 4 to qualify.
Okay, what's the first one?
First is business purpose. The expense have to be intended to produce income. This is the intent test.
So a dinner with a client where you talk about a contract that has a business purpose.
Right. That same dinner with your spouse where you don't talk business usually does not.
What about the second one?
The second is ordinary. The expense has to be typical for your industry and the size of your business.
So a small local marketing firm flying its owner to Paris for dinner is probably not ordinary.
Probably not. The tax court would likely object. But if you're a top executive at a multinational fashion house, flying first class to review a new line is ordinary for that industry. The definition changes with scale and context.
Okay, third.
Third is necessary. The expense has to be important for the business's growth, profitability, or market share. This one's a bit subjective, but it's crucial.
So you could spend money on something that's ordinary, but if it doesn't clearly help the business, it might fail this test.
Exactly. Like buying a wildly extravagant car when a modest one would do just fine for client meetings. It might have a business purpose, but it might not be necessary.
And the last one is obvious but important.
Documented. Every country is obsessed with documentation. You have to prove it all with receipts, logs, invoices, detailed notes. If you have imaginary documentation.
You get an imaginary deduction.
Right. And these deductions aren't just for daily costs. They extend to big investments called capital expenditures. Businesses can deduct the cost of assets over time.
And some countries, like the US, the UK, Canada, they even allow immediate write-offs for certain assets, which is a powerful way to stimulate investment right now.
We also see big incentives around debt. The deductibility of business interest expense, which is allowed in the US, Australia, India, and others, is critical. It encourages businesses to borrow money to expand quickly, which grows the overall money supply.
And to make sure that expansion isn't choked off by too much tax, we have to talk about flow-through entities.
The traditional corporate model has what's called double taxation.
The corporation pays tax on its profit, and then the owner pays tax again when they get a distribution, like a dividend.
It's a huge drag on investment, so most Western countries allow these flow-through entities, like partnerships or LLCs. They only tax the income once, directly at the owner's level. This fuels so much more investment and growth because the owners keep more of their capital.
So beyond the basics, there are some pretty advanced strategies that sophisticated businesses use.
Definitely. Let's look at two key areas. First is accounting methods. The cash method of accounting is incredibly powerful, even though it's usually limited to smaller businesses.
And this just means you recognize income only when the cash actually hits your bank account.
Exactly, not when you send the bill. Compare that to the accrual method, which recognizes revenue right away. So imagine a business ends the year with $400,000 in accounts receivable, money people owe them, but only $50,000 in accounts payable.
Under accrual, they have a $350,000 profit on paper.
And they have to pay tax on it immediately, even if they haven't collected a dime. By legally electing the cash method, they can defer that tax liability until the cash is actually in hand. This simple choice can be worth hundreds of thousands in liquidity.
That is massive for cash flow. And then there are net operating losses, or NOLs.
Right. This happens when a business's deductions are legitimately more than its income, creating a taxable loss. This is standard for high-growth startups that are just pouring money into R&D or infrastructure.
And the rules let you carry those losses forward to offset future profits.
Sometimes for decades. The mechanism is specifically designed to incentivize high-risk, high-reward entrepreneurship. It's the government sharing the burden of those initial losses.
And we've seen huge companies like Amazon and Tesla use these rules incredibly well.
They invest billions early on, create massive losses, and then legally use those losses to reduce or even eliminate their taxes for years, even after they become super profitable.
Which is why you hear politicians complain about big companies paying zero corporate tax. It's not cheating.
It's the intentional function of the NOL rules. It's the government rewarding them for that massive early investment and risk-taking. They took the risk, and the government is now paying its part of the bargain.
So let's solidify the win-win here. What's the government's return on investment?
Okay, let's use a startup example. Say a taxpayer is in a 33% tax bracket and has $10,000 in initial deductible costs. The government's investment is $3,300 in taxes it didn't collect. If the taxpayer invests another $20,000 over the next 2 years, the government shares another $6,600. So the government's total cost is $9,900.
Okay.
Now, in year 3, the business is stable and starts making $50,000 in annual profit. The government collects $16,500 in tax on that.
So they've already gained $6,600 more than their initial cost.
Which is a remarkable 67% ROI in that 3rd year alone.
But this is where it gets crazy. After that initial investment is paid back, the government's return becomes
infinite. They have zero net capital at risk, and they just keep getting 33% of the income forever. And then if the business hires 2 employees, the government collects even more from their wages and payroll taxes. It's an unbeatable deal.
Now, for the taxpayers' payoff, this is about repositioning personal costs.
So imagine you start a genuine side business. You spend $4,500 on a computer and supplies. You now qualify for a home office deduction, say $1,000 a year. You start using your car for business, deducting mileage, maintenance, another $9,000.
Your total first-year deductions could easily be over $15,000.
At that 33% tax bracket, those deductions are worth almost $5,000 in tax savings.
And notice that saving is more than the initial $4,500 you spent on the computer and supplies.
Exactly. You would have had the car in the house anyway, but by repositioning them for the business, the government essentially gives you a permanent 33% discount on all future business expenses. The government effectively paid for your entire initial investment because you're doing what they want, creating a long-term economic entity.
Okay, let's move to the second investment category, technology and R&D.
Right. And if the business incentive is about job stability, the R&D structure is all about managing risk and driving transformation.
R&D is super costly and high risk. I mean, it produces way more failures than successes.
Which is why government incentives are absolutely vital. Private investors might just avoid it otherwise because the probability of failure is so high.
And the government's purpose here is heavily skewed toward defense, healthcare, and economic transformation.
For sure. Technology directly supports defense, like cybersecurity, but also critical health initiatives. We saw this in action during the COVID pandemic.
Yeah.
Governments just massively incentivized vaccine R&D, not just for health reasons, but because recovering quickly from any vulnerability, biological, technological, whatever, is central to national security. The faster the vaccine, the faster the economic recovery.
And the results of R&D on the economy are just staggering.
They are. I mean, look at agriculture. Cereal production is up 250% since 1960, mostly because of tech. In energy, fracking, while controversial, made the U.S. energy independent. In construction, new modular techniques are rapidly increasing housing availability. These are multi-trillion-dollar shifts driven by private R&D that's backed by tax incentives.
So to make sure businesses are claiming credits for real innovation and not just, routine maintenance, there are 4 rigorous tests.
Right, and governments globally use these. First is the elimination of uncertainty.
This is the core test.
It is. The activity has to be trying to overcome an unknown outcome. If you know exactly how it's going to turn out, it's not research.
Second test.
Technological basis. The research has to be based in scientific, engineering, or computer science principles. Testing a new marketing slogan is not R&D.
But experimenting with 3 different molecular compounds for a new glue is.
Precisely. Third is new or improved business component. And this is where a lot of small and medium businesses miss out.
Because the definition is broad.
It's very broad. It covers any product, process, software, technique that's either for sale or just used in the business itself. And crucially, it only has to be new or improved to your business, not to the whole world.
So if a small brewery optimizes a process to use less energy, that qualifies.
That's a qualifying improvement. And the fourth test is a process of experimentation. You have to show a systematic trial and error approach to evaluate alternatives.
Like beta testing software to find bugs and improve it.
That's a classic example. Just installing off-the-shelf software is not R&D. But modifying that software to work with your old in-house system, that usually is.
So the key takeaway for a business owner listening is that if you've spent money upgrading your internal software or redesigning a process, you've probably got qualifying R&D costs.
You almost certainly do.
Okay, so let's look at the financial leverage here for the government in R&D.
The whole strategy is to give a small initial incentive, like a 10% credit, for the chance of enormous long-term rewards.
Let's run the math.
Okay, a $130,000 R&D project. The government might give you $43,000 in initial incentive. That's their cost.
Yeah.
If the project works and generates $100,000 in profit a few years later, the government gets $33,000 in tax every year.
So on a $43,000 cost, they're collecting $33,000 per year. That's a 76.7% ROI. Every single year.
Every year. And once they've recouped that initial $43,000, their return is infinite. Plus, if the technology is sold later for a huge gain, they get a massive capital gains tax windfall. The potential return is over 600%.
And for the taxpayer, the payoff is even more dramatic because you're using these credits to fund the development itself.
Right. Let's use the real figures from the author's company, Wealthability. They spent about $400,000 developing new software.
Not theoretical. Real money.
Real money. The federal R&D tax credit was 10%, $40,000. The state credit was 20%, $80,000. That's $120,000 in direct credits. Then they got a deduction for the rest of the cost. At a combined tax rate of 41.5%, that yielded another $147,600 in deduction benefits.
So if you add that all up, the government effectively contributed. What is that?
$267,600, or a staggering 67% of the total R&D cost. The business owner only paid about $132,000 out of pocket.
And if that software makes $1 million in profit, they only share 41.5% with the government, even though the government funded 2/3 of the development.
That is the definition of leveraging government money. So the actionable question for you to ask your advisor is simple. Has my business added new features, modified technology, or changed a process in the last 3 years? If the answer is yes, you are almost certainly entitled to substantial tax benefits.
Okay, let's move to our third and final category for today, real estate.
And this is maybe the most heavily incentivized investment type in the world.
Because it hits multiple government goals at once. Housing, commercial development, construction jobs.
Right. Shelter is one of those 5 basic human needs. And governments are highly motivated to make sure there's enough housing because homelessness is a massive social and political issue everywhere, from Paris to San Francisco.
The power of real estate as a wealth builder is really clear in personal stories. The author's family anecdote really captures this.
About his parents.
Yeah, they owned duplexes and a triplex, pay them off, and just lived off the rental income for decades. And when he, as a young CPA, looked at their tax returns, he saw the enormous tax benefits they were getting year after year.
And that experience really solidified his view that real estate is just one of the most tax-advantaged investments you can make.
So the foundational tax incentive in real estate is this deduction called depreciation.
Which is supposed to account for the theoretical wearing out of the building.
But what's so unique is that the tax code gives you this big deduction even while the asset itself is often appreciating in value. You're getting a tax break on a phantom loss.
And those depreciation schedules reduce your taxable rental income, often down to 0.
But the really sophisticated strategy, especially in the U.S. now, is cost segregation.
Right. This rule lets you break down the purchase price of a building into 4 components for tax purposes. The land, which doesn't depreciate, the building structure, which has a long life, land improvements, shorter life, and contents, which have a very short life.
So by hiring engineers to do a study, you can reclassify a big chunk of the value, things like carpet, fixtures, landscaping, into these shorter life categories.
Which is the key to acceleration. The law allows for bonus depreciation, meaning you can write off 30% or more of the building's value in the very first year by accelerating the depreciation on those short-life assets.
So $1 million building can generate massive deductions in year 1.
Huge paper losses that can offset your other income. It's an enormous tax benefit right away.
And beyond depreciation, governments use these very specific targeted credits to direct money where it's needed most.
The most famous is the low-income housing tax credit, which is a powerful incentive that can cover up to 70% of the cost of a new building over 10 years.
And there are others for preserving historical buildings or making properties accessible for the disabled.
They ensure that capital flows exactly where the government wants it to go.
So the tax benefits don't stop when you're collecting rent. They continue or even accelerate when you sell the property.
Absolutely. First, there's the capital gains advantage. In almost every developed country, gains from selling long-term investment real estate are taxed at much lower rates than your regular income.
And then there's this really sophisticated synergy between depreciation and capital gains.
The depreciation recapture differential. So as we said, you deduct depreciation against your ordinary income, which could be taxed as high as 37%. When you sell, that depreciation is recaptured or taxed back.
But at a lower maximum rate, currently 25% in the U.S.
Right. So let's follow the money. If you took $250,000 of depreciation over the years, that saved you $92,500 in tax at that high rate. When you sell, the recapture only costs you $62,500 at the lower rate.
That 12% difference is a permanent $30,000 tax savings.
It is. The government essentially loaned you $92,000 interest-free and only asked for $62,000 back. It's a permanent benefit that's unique to real estate.
And then the most advanced strategies let you defer or even completely eliminate the tax when you sell.
The like-kind exchange, or 1031 exchange in the U.S., lets you defer all capital gains and depreciation recapture tax if you reinvest the money into another investment property within a strict time frame.
So your capital can just keep growing tax deferred, potentially for generations.
Which leads to the ultimate generational wealth strategy.
Yeah.
Buy, borrow, die.
Sounds ominous.
It's powerful. If you hold investment property until you die, the appreciation and all that accumulated depreciation are permanently eliminated from income tax.
Because of the step up in basis.
Exactly. Your heirs get a new cost basis, resetting it to the fair market value at the time of your death. So if a property you bought for $1 million is now worth $3 million, your heirs can sell it immediately, tax-free. $2 million in appreciation, and all the recaptured depreciation just vanishes from the tax rolls forever.
That's how multi-generational wealth is protected.
That's how it's done.
So let's wrap this up with the win-win payoff for real estate.
Right.
What's the government's ROI?
Okay, take a hypothetical $1 million fourplex. The taxpayer invests $200,000 and borrows $800,000. The government's initial investment in tax deductions might be around $99,000 in year one.
Okay.
If the property yields $100,000 in net operating income in year two, the government collects $16,500 in tax.
Plus, the interest paid to the bank on the loan is also taxed at the bank's corporate rate.
Right, which generates another $8,000 in tax revenue. So that's over $24,000 in tax collected on an initial cost of $99,000. That's a 25% ROI for the government in year two alone.
And that doesn't even count taxes from the property manager's wages or the utility companies.
Not at all. The government gets huge ongoing revenue and new housing, all without taking on the risk or expense of building it themselves.
And for the taxpayer, the payoff is massive tax acceleration and wealth building, especially with leverage.
The combination of interest deductions and accelerated depreciation is often enough to completely offset the rental income.
So you have positive cash flow in your pocket, but on paper, the tax code says you made a loss.
Exactly. And we have to bring back that stunning real-world example from the book. The real estate investor who put $285,000 into a multifamily deal.
His share of the bonus depreciation in year one was $260,000.
At a 37% federal tax rate plus another car deduction, his total tax benefit was $103,000.
And he used $95,000 of that tax reduction for the down payment on a new Ferrari.
A $285,000 Ferrari. The government effectively paid the down payment for his luxury car simply because he legally followed the tax code and invested in housing, which is a critical national priority.
Okay, so let's try to synthesize what we've learned here. We've done a deep dive into these first three major investment categories: business, tech, and real estate, where governments are just actively looking for your capital. And we've learned that tax law isn't some random maze of rules. It's a clear, intentional reflection of national priorities. Jobs, security, innovation, housing.
And the sophisticated investor, the active partner, uses this roadmap to pay less tax, not by cheating, but by intentionally and legally doing exactly what the government wants them to do.
If we connect this to the bigger picture, the fact that these strategies are so consistent across different countries, it just confirms they are intentional design features of stable economies.
The rules aren't hidden, they're just complex. So your mandate as an active partner is to actively review your own investment strategy and deliberately choose these government-sponsored activities, recognizing that this is the best, most protected path to building generational wealth.
So what does it all mean? It means the rich understand that investing in these incentivized activities makes them much richer and lets them pay less tax. It's all about partnership and strategy.
Right. When we hear about major companies or high net worth investors paying very little tax, it's often because they've used the tax code exactly as the lawmakers intended to, incentivize massive investment and risk-taking in things society needs, like infrastructure and housing.
It all comes back to that Ferrari example, doesn't it?
It really does. I mean, it sounds outrageous, but it is the perfect illustration of the principle.
He used a tax break for housing, which is a huge government priority.
To help buy a luxury car. The government is demonstrably willing to effectively fund your biggest personal goals as long as those goals are linked to one of its core priorities.
So the final thought, the question for you to really mull over is this.
What national priority are you currently neglecting that could pay for your next large investment?
Thank you for watching. Please like, rate, share, subscribe, follow up on next topic.
Okay, let's unpack this. We are coming back to continue our deep dive into the blueprint for wealth creation laid out in the win-win wealth strategy.
That's right.
Last time, we covered the first three essential investment pillars: business, technology, and real estate. If you recall, the core idea is that the government intentionally uses the tax code, not as a, confusing minefield designed to trip you up,
Not all.
but as a treasure map, a tool of intentional policy.
A very intentional policy, yes.
Yeah.
And it's designed to leverage private enterprise, private money, to meet the 5 core non-negotiable goals of every single functioning government.
And those are keep the peace, protect the people, feed the people, shelter the people, and educate the people.
That foundation is absolutely crucial. And if you're just tuning in, the paradigm shift we discussed is moving from being a silent partner, someone who just pays tax on every dollar earned with no real strategic input.
Just writing the check.
Just write the check.
Yeah.
To becoming an active partner.
Yeah.
An active partner is someone who strategically aligns their investment capital with the government's established priorities. And by doing that, they get access to those generous, intentional tax incentives to build massive tax-advantaged or even, tax-free wealth.
So today we complete the map. We're shifting focus from, foundational stability like jobs and housing to things that feel even more primal.
I think that's a great way to put it.
Yeah.
We're talking about national security and the fundamental necessities of human existence.
Yeah.
Energy, food, security, and long-term financial care.
These categories aren't optional, are they?
Not at all. They are absolutely crucial to maintaining national stability, and they directly relate to the government's need to keep the peace and protect the people.
That reframing helps us understand why these next 4 investment categories, energy, agriculture, insurance, and retirement, are treated so generously in the tax code.
Exactly.
They aren't just market opportunities, they feel more like extensions of state function.
Precisely. If the private sector handles these necessities effectively, the government faces less risk of instability, less need for welfare or emergency intervention, and a lot less strain on national resources.
That's the win-win proposition.
That's the whole ball game.
Let's jump straight into investment number 4. This is a massive area, both politically and economically, on a global scale. Energy.
Huge.
The government goals here are, they seem complex. Sometimes they even look contradictory, but they are ultimately unified.
They all point in the same direction.
Environment, productive competitiveness, and maybe above all else, national security through energy independence and resilience.
Right. Energy is power, literally and figuratively.
What's immediately fascinating, which the source material brings up, is the varying global perspective on who should even be allowed to own and develop these vital resources.
It's a stark contrast, isn't it? The ownership models are completely different, and that dictates how the incentives have to be delivered.
How so?
Well, if you look across major parts of the world, the Middle East, much of Europe, Asia, South America, the state typically reserves the exploration, extraction, and development of oil and gas for the government itself.
It's treated as a national asset.
A sovereign national asset controlled through nationalized companies.
Right, like a Saudi Aramco or Russia's Gazprom.
Exactly. But then you have a smaller yet economically powerful group of countries, including the U.S., Canada, Germany, Japan, Spain, and Taiwan, which explicitly allow for private ownership and development.
So private citizens can own the oil under their land.
Correct. And this private ownership model, particularly prevalent in North America, means that tax incentives become the primary policy lever. The government can't just mandate production like a state-owned company can.
So they have to entice people.
They must use the tax code to incentivize private capital to take on the financial risk.
And those incentives really do drive behavior, even among people who might otherwise be sort of neutral on the topic.
Oh, absolutely.
The author, Tom Wheelwright, he provides a really telling anecdote about installing solar panels on his own studio. He admitted he was motivated, not necessarily by, some deep commitment to environmental activism,
Which is fine.
but primarily because the terrific tax benefits essentially made the financial decision a complete no-brainer. It just pushed him over the edge.
And that's the perfect demonstration of intentional policy. It's not an accident. The government wants more clean energy capacity.
Right.
And to overcome that high initial capital cost that makes private investors hesitate, they just shift the economics overwhelmingly in the investor's favor.
They use the tax system to engineer behavior.
That's it exactly.
Let's unpack the mechanics of this, starting with the traditional sources that have long been prioritized. Fossil fuels. They have some of the most, enduring and powerful incentives in the entire tax code.
They absolutely do. Fossil fuels, oil, gas, coal, they benefit from these long-standing provisions that let investors deduct various production costs. But there are 2 specific incentives for oil and gas that really stand out. They signal the government's enduring priority for energy independence. The first one is related to the immediate costs of just getting the resources out of the ground, the intangible drilling costs, or IDCs.
What exactly are IDCs? The word intangible throws me a bit. What does that cover, and why is it treated so favorably?
It's basically the non-physical costs tied to drilling a well. So think about the labor wages, the fuel, the supplies that are consumed during the process, and the site prep costs.
So, not the pipe itself, but the cost to get the pipe in the ground.
Precisely. And these costs are massive. Normally, under standard accounting rules, you'd have to capitalize them, spread them out, and deduct them over the life of the well.
Which could be decades.
Could be. However, for investors who take on the direct risk of development, IDCs are 100% deductible in the year of the investment.
The same year you spend the money?
The very same year. The government is front-loading the benefit, mitigating that huge initial risk of exploration and development.
100% immediately deductible is huge for cash flow. But the source includes a crucial caveat here. You typically cannot take this deduction if you own your interest through a limited liability company, an LLC.
Right.
What is the policy intent behind that specific restriction?
That restriction goes right back to the core concept of risk and active participation. The government wants to reward those who are truly taking the financial risk directly, often referred to as working interest owners.
So they want skin in the game.
They want real skin in the game.
Mm-hmm.
And historically, the IRS and Congress have viewed LLCs and similar entities as mechanisms that can dilute that personal risk, or sometimes shield the investor a little too much from liability.
I see.
By restricting the IDC deduction to direct owners, the government ensures the most generous benefit goes to those who are most invested in the success and the failure of the actual drilling operation. It's about encouraging hands-on, high-risk capital.
Okay, so that handles the big upfront cost. But then there's the rule that has generated wealth for decades and always seems to sound, frankly, too generous to be true: percentage depletion.
Ah, yes.
I have to ask, isn't this rule highly controversial? I mean, why would the government allow a deduction based on sales rather than the actual cost of the asset?
It is indeed controversial, primarily because it's what we'd call non-economic. Depletion is conceptually like depreciation. It's a deduction for the loss of the resource in the ground. You deduct the cost as the asset is consumed.
Right, so once you've deducted your original cost, you should be done.
That's what standard accounting would require. You stop deducting once you've recovered your original investment.
Okay.
But percentage depletion is this phenomenal incentive because it allows a 15% deduction of the gross oil or gas sales price,
Okay.
irrespective of the remaining reserves or the original development cost.
Wait, irrespective of the cost, meaning even if I've already recovered my entire investment 100 times over, I can just keep deducting 15% of the income forever.
Precisely. For as long as that well is producing.
Wow.
What this means in practice is that only 85% of your income from that production is ever subject to tax. And that's before you even start deducting your normal operating costs, like maintenance, transportation, and admin expenses.
That's an incredible permanent advantage.
It is. The government is essentially making an enduring generational commitment. They're saying, we only expect to tax 85 cents of every dollar you bring in from this vital resource permanently.
And the rationale for it surviving all these political shifts is just...
It works. It's that simple. It works. It keeps capital flowing into domestic energy production, which is a fundamental component of national security, regardless of which party is in power.
That is a deep-seated policy. Okay, now let's flip to the new frontier, renewable energy. How do the incentives for solar, wind, and hydrogen compare, especially since the global mission seems focused on shifting away from fossil fuels?
The incentives for renewables are tailored a bit differently. They often focus on accelerating the timeline for cost recovery and, critically, providing direct credits. The need for these is global, driven by both environmental goals and productive competitiveness.
And the source notes that even in countries that are really strict about state-owned fossil fuels, you still see strong tax incentives for private development of renewables.
That's right, because every country wants that infrastructure.
So how does that look globally? Like in Argentina, Australia, or Mexico, how do they play this game differently?
Well, a lot of those countries rely heavily on mechanisms like accelerated depreciation. This lets investors recover the cost of their capital equipment. Solar farms, wind turbines, much faster than its actual useful life.
So instead of writing it off over 20 years, you do it in 5.
Or even 1. In Australia, for example, certain clean energy assets might qualify for immediate expensing. That dramatically improves your cash flow. In the U.S., however, the most powerful tool is often the tax credit.
And a tax credit is fundamentally different and far more valuable than a deduction.
Miles more valuable.
We need to pause here because that distinction, credit versus deduction, is constantly confused. And for a deep dive like this, we need absolute clarity. What is the explicit difference?
It's vital. A tax deduction reduces your taxable income. So if you have a $10,000 deduction and you are in a 40% tax bracket, you save $4,000 in taxes.
It reduces the amount of income you pay tax on.
Exactly. A tax credit, however, is a dollar-for-dollar reduction of your actual tax bill. A $10,000 credit reduces your taxes by $10,000, regardless of your tax bracket.
So a credit is worth its full face value.
Instantly.
Yeah.
100%. It makes it exponentially more powerful than any deduction.
Understood. Now let's apply that to the U.S. solar credit example. The book highlights the 26% tax credit for installing solar panels.
So the U.S. offers this 26% credit, whether you're a homeowner or a business. But here's where the policy nuance comes into play, creating that win-win.
Okay.
For a homeowner, that 26% credit is a pure permanent benefit. And the reason why is because a homeowner's energy costs were never deductible in the first place.
So the government isn't losing a deduction on the other end.
Exactly. They don't share in the homeowner's future savings. The tax code is just giving them a free boost to go green.
But for a business, it's a completely different equation because the government does eventually share in the benefit.
Precisely. When a business installs solar and reduces its energy costs, that reduction in expense also reduces the business's overall operating expense deductions.
A smaller deduction means a higher taxable income.
Which means the business pays more tax down the line. The government is essentially saying, we gave you a big credit up front, but now that your operating expenses are lower, we're going to collect a little bit back from a higher tax base over time.
This sounds like where the combined synergy of the credit and the deduction for the business becomes this incredible financial advantage. Let's walk through the math on that.
Let's use the $100,000 solar system example from the book.
Perfect.
First, the business immediately gets a $26,000 tax credit. That's 26% of $100,000, dollar-for-dollar tax reduction.
Straight off the bill.
Gone. Second, they also get to deduct the cost of the system through depreciation. Now, to account for the credit they just received, the government reduces the cost basis by half of the credit.
Okay, so a small adjustment.
A small adjustment. The depreciable basis becomes $100,000 minus half of the $26,000 credit, which is $13,000. So the total depreciation deduction is $87,000.
And that $87,000 deduction creates tax savings.
Right. If the business is in a combined 40% tax bracket, that $87,000 deduction saves them another $34,800 in taxes.
So let me get this straight. You get $26,000 in a direct credit plus another, almost $35,000 in tax savings from the deduction?
That's right. You add them together.
That's a total tax benefit of $60,800.
Correct. The total tax benefit is just over $60,000 on a $100,000 system.
So the net cost to the business is only $39,200. The government just paid for over 60% of an infrastructure project.
And that's how you leverage private investors to meet a national priority.
That benefit is just huge. But it does raise a question of sustainability and, political risk. If the government is covering 61% of the cost, how secure can you be that a future administration won't just claw that back or reduce those credits?
That's where you have to look at the policy drivers globally. When political leaders, regardless of country or party, are making these massive long-term commitments, like Joe Biden's $400 billion clean energy promise in the U.S., or France's 2040 ban on fossil fuel car sales, or the UK focusing so heavily on wind,
They're setting a course.
they're setting a very clear long-term trajectory. This global consensus on the need to reduce emissions and shift infrastructure over the next decade, it all but guarantees that massive sustained tax deductions and credits will remain available for energy investors.
The incentives are necessary to make the goals happen.
Exactly. They need to deploy private capital at a speed and scale that you can only get with these kinds of benefits. The political risk is low because the national necessity is so high.
Okay, so let's look at the government side of the ledger. They just spent, in a way, $60,800 in tax revenue. What's their payoff?
Well, while the $26,000 credit is a direct revenue loss, they do see a specific financial return on their depreciation investment.
How does that work?
If that $100,000 system reduces the business's energy expenses by, say, $7,400 per year, the government now starts collecting tax on that $7,400, which was previously a deductible expense.
Ah, because the business's profits are now $7,500 higher.
Precisely. At a 40% tax rate, the government recoups $2,960 annually.
So that translates to an 8.5% ROI on their $34,800 depreciation investment. Not bad.
An excellent sustained financial return for leveraging private capital. But just as important is the non-economic benefit. A 100-kilowatt system like that saves about 153 tons of CO2 emissions per year.
So the payoff is multifaceted.
It is. Financial return, environmental improvement, and enhanced energy security. The author's personal ROI example, where his $104,000 system only cost him $35,648 net and provided a 20.74% return, is a practical, almost risk-free illustration of this partnership in action.
It truly shows how aligning your capital with government goals completely transforms your investment's risk profile. And that sets us up perfectly for investment number 5, which deals with another core necessity, deeply tied to stability and national security: food, or agriculture.
Yes, another fundamental pillar.
When we talk about the government's purpose in agriculture, we're really talking about the base requirements for civilization: food, shelter resources like timber, and exports for trade stability.
Absolutely. And as the source notes, stability is the critical word here. The USDA lists food security as its #1 priority for a very good reason. History teaches us over and over that the fastest way to civil unrest is a hungry population.
The historical evidence for that is just overwhelming, isn't it?
It is. Look at the example cited in the book. The Arab Spring Uprising, which was largely fueled by widespread dissatisfaction due to low standards of living and rising food prices.
Right.
Or the civil wars in Yemen and Syria, where the lack of basic necessities played a key role in destabilizing the entire region.
And even going back centuries.
Even further, the success of medieval siege warfare was predicated entirely on starving a city into submission. A country that cannot feed itself is fundamentally vulnerable. That makes agriculture a linchpin of keep the peace.
Given that immense importance, it makes perfect sense that the incentives for agriculture are amongst the most powerful the government offers. We're talking about deductions for nearly all expenses, special credits, favorable rules for co-ops.
They are very, very generous. But this brings us immediately to the most important hurdle for any investor considering this sector. You have to differentiate a genuine business from a hobby.
The government is not going to subsidize your weekend gardening project.
Exactly. They explicitly forbid tax deductions for hobbies no matter how much you enjoy them.
So if I buy a sprawling estate and I want to claim a deduction for the little vineyard I tend to every weekend, the IRS is going to shut that down pretty fast unless I can prove I'm running a serious operation.
Correct. It must be a legitimate business with a demonstrable profit motive. In the United States, the IRS uses what's known as the 9 factors test. But the most prominent measurement is the bright line test.
The bright line test, what's that?
It says the activity must show a profit in 3 out of 5 consecutive years.
3 out of 5.
They do provide an exception for riskier activities like horse-related businesses, breeding, training, racing, which are allowed 2 out of 7 years.
3 out of 5 years seems like a genuine challenge, especially in an industry like farming where commodity prices can fluctuate wildly, and you might intentionally front-load deductions in the early years for investment purposes.
This is where financial IQ really separates the strategic investor from the ordinary taxpayer. The good news is that the 3 out of 5 rule is not an absolute ironclad rule. It's merely a rebuttable presumption.
Meaning you can argue against it.
You can. If your intent is genuinely profit-driven, and you can demonstrate that with management expertise, a solid business plan, and proper capitalization, you can still qualify as a business, even if you show tax losses frequently.
And you prove that by showing positive cash flow, even with the tax losses.
That's the key. This is the concept the source terms the phantom deduction strategy.
I love that term, phantom deduction. It suggests financial health despite what the tax return says. Let's walk through the cash flow example to show exactly how a farm can be financially robust and operational, yet still generate massive deductions for tax purposes.
Let's build a scenario. An investor decides to get into specialized agriculture, maybe building some state-of-the-art greenhouses.
Okay.
They borrow $500,000 for the equipment and the structures. Assuming that loan is amortized over 20 years, the annual loan payment is roughly $36,891. That includes both principal and interest.
Okay, so that's the cash going out for the debt, now for the income and deductions.
Let's say the farm generates $97,000 in operating income. After paying that $36,891 loan payment, the business has a whopping $60,109 in hand. That's positive cash flow that goes directly into the investor's pocket.
So financially, they're healthy. They're making money.
They are. Now, we apply the special tax rules. Because of incentives for agriculture, you can often accelerate the deduction for farm equipment and single-purpose structures like greenhouses. So if that $500,000 is expensed over just 5 years, the annual depreciation deduction is $100,000.
Okay, so we have $97,000 in operating income, but a $100,000 non-cash deduction from depreciation.
Correct. So for tax purposes, the calculation is your operating income minus depreciation. Plus, you have to add back the non-deductible loan principal repayment.
So even though the investor puts 60 grand in their pocket.
Even so, the calculation results in a tax loss of $23,000 for the year. The investor just captured $60,000 in cash while successfully claiming a $23,000 loss against their other income, maybe from a salary or another business.
That is leveraging the tax code as a mechanism for pure, immediate cash flow generation. It completely changes the financial viability of the investment by mitigating that initial cash drain.
It absolutely does. However, we have to heed the cautionary note included in the source. Agriculture is inherently risky.
Right, the tax benefits don't make the crops grow.
Exactly. They're phenomenal, but they do not eliminate the underlying business risk of crops failing, weather events, or market prices just dropping out from under you.
So the active partner has to be smart about the business itself.
You have to approach debt strategically, maintain immaculate financial statements, and accurately project your cash flow. The tax strategy only works if the underlying business is sound.
Beyond that big depreciation strategy, what are some of the other specialized incentives designed to stabilize the food supply chain?
Well, the government uses specific credits to guide investment towards strategic areas. For instance, in the U.S., there are credits for producing alcohol fuels, biodiesel, distilled spirits, and specialized agricultural chemicals under specific IRS sections.
And what about for collaboration?
Cooperative farming structures often receive highly favorable tax rules to encourage that kind of collaboration and economies of scale, and a very strategic rule for risk mitigation. Farmers and ranchers have special exceptions, allowing them to use commodity futures transactions.
The straddles, they're called?
Known as straddles, yes, to hedge against price volatility. And those hedges receive beneficial tax treatment as a form of business insurance.
Let's analyze the government side of the equation for these generous agricultural incentives. The book uses a long-term timber farming example, which I think encapsulates both the financial and environmental payoff really well.
The timber example is excellent because it showcases patience and delayed gratification, which is often necessary in these non-qualified plans.
So what's the setup?
An investor buys land, spends capital, planting and maintaining trees over a 7-year period. Because all those expenses are deductible, at a 40% tax rate, the government shares approximately $568,000 of the cost over those 7 years.
That's the upfront investment made by the government in the form of tax revenue they chose not to collect.
Exactly. Now, starting in year 8, when the trees are mature enough to be sold, the investor starts earning $300,000 in taxable profit annually. The government, now being the tax partner, receives 40% of that profit.
Which is $120,000 per year.
$120,000 a year.
So they recoup their entire $568,000 investment extremely quickly.
In less than 5 years, they're in the black. The annual return of $120,000 on that initial $568,000 investment calculates to a very robust 21.13% ROI, achieved with no additional financial outlay from the government.
And again, there's a non-economic payoff.
And again, that might be the most valuable part. That timber project reduces 871 tons of greenhouse gases every year. So the government receives resource security, environmental cleanup, and a strong financial return, all by strategically leveraging private capital.
That's a compelling case for aligning capital with these major stability goals. Let's move to investment number 6, insurance, which also speaks directly to that core need for peace and stability, but by mitigating catastrophic risk.
A different angle on the same problem.
When we think of insurance, we often think of personal protection, not necessarily government function. So what is the government's core purpose in incentivizing a robust private insurance sector?
The core purpose is stability and security, which again feeds right into the keep the peace goal. Insurance is the mechanism that spreads risk thinly across a huge population.
So one person's disaster doesn't become everyone's problem.
Exactly. If a wildfire destroys a community or a company's CEO dies unexpectedly, you rely on the insurer to provide the funds, not the state. This drastically reduces reliance on government welfare or emergency aid, and that keeps the peace by managing social catastrophe privately.
And it also supports the broader economy, right? Life insurance companies aren't just sitting on piles of cash.
Not at all. They are some of the largest, most stable long-term investors in the world. They invest massive reserves in infrastructure, corporate bonds, real estate. They're fueling economic development and providing stability to the credit markets.
The scale is just remarkable. The source notes that life insurance companies distributed over $1 trillion in contract payments between 2010 and 2017 in the U.S. alone.
It's a staggering number.
And to put that in perspective, it's equivalent to 20% of all Social Security benefits paid during that same period.
It is a measurable, massive reduction in the potential reliance on the government safety net. It's a quantifiable reduction in the government's burden. The system works by shifting risk and responsibility to private pools of capital.
This is where the importance of professional advice really comes in. The author cited his mother's wisdom. The two most important professionals in your life are a good CPA and a good insurance agent.
And that makes complete sense now, seeing how deeply embedded insurance is in tax law and national strategy.
So let's look at the specific tax advantages.
We can break it into two parts: deductions and non-taxable payouts. Health insurance is the most obvious tax benefit. It's estimated at $215 billion in the U.S. It's a larger tax benefit than all corporate tax benefits combined. Employer-paid premiums are deductible for the business and are non-taxable compensation for the employee. That's a massive incentive to provide health security.
And the compensation side is where the government gives that double incentive.
Precisely. If you receive compensation for physical injuries or health issues, think workers' comp or personal injury settlements, that income is typically non-taxable in many countries, including the U.S., Germany, and Japan.
So you get tax benefits on the premium and a non-taxable payout if catastrophe strikes.
It's a huge driver for private insurance.
Now, for life insurance, the premiums for traditional life insurance are generally not deductible. What's the rationale there?
It follows a logical tax flow. Premiums are generally not deductible because the death proceeds themselves are generally non-taxable income to the beneficiary.
Oh, okay.
This is true in most developed nations, including the U.S., Japan, and Mexico. If you pay the premium with after-tax dollars, the benefit comes out tax-free. The government isn't sacrificing tax revenue on the way in, so it doesn't tax the payout on the way out.
But there's a crucial high-level planning strategy here that applies to estates and generational wealth transfer.
This is one of the most powerful tools in estate planning. While life insurance proceeds are generally income tax-free, they are included in the deceased person's estate.
And can therefore be subject to inheritance or estate tax?
Exactly. If the deceased own the policy, the strategic move is simple but profound. If the heirs own the policy, or if the policy is held within an irrevocable life insurance trust or ILIT for their benefit, the death proceeds bypass the decedent's taxable estate entirely.
So the money escapes both income tax and estate tax?
Both. It ensures that generational wealth transfer is maximized.
That's the ultimate goal of the active partner, isn't it? Building wealth that lasts for generations without being eroded by the state.
That's the pinnacle.
Now let's discuss permanent insurance and the cash surrender value, or CSV. How does this investment portion grow tax-free, and why is that so important?
The cash surrender value is the investment component of a whole life or universal life policy. And critically, this cash value grows tax-deferred. You don't pay tax on the earnings every year, which allows for powerful, uninterrupted compounding growth.
And it only becomes taxable if you cancel the policy and pull the money out.
Right. And if the policy is held until death, the entire CSV is included in the income tax-free death benefit, meaning the tax is delayed forever. It's a permanent tax exclusion on that growth.
And this is where the high-level financial IQ investor leverages that asset. You don't want to cancel the policy, so you take a loan against the CSV.
Correct. The CSV can be used as collateral for a loan from the insurance company. And this is the key structural advantage. Since the money is borrowed against the policy's cash value, not withdrawn from it, it is not a taxable event.
So the principal CSV remains intact.
And critically, it continues to grow tax-free, compounding against the tax that has been permanently deferred. The investor gets access to capital without liquidating their tax-advantaged asset.
And this leads us directly to the interest tracing rule, which connects the insurance strategy to other incentivized investments like real estate or business.
The interest tracing rule is the cornerstone that makes this leveraging strategy so powerful. It's a rule in many global jurisdictions: the U.S., Canada, France, Germany, Japan.
And what does it say?
The rule dictates that the deductibility of any interest expense is determined entirely by how the borrowed funds are used, not where they came from.
So if I borrow money against my tax-free growing insurance policy, and then I use that capital to invest in a tax-incentivized activity, the interest I pay on that loan is suddenly deductible.
Precisely. You are turning a non-deductible expense, life insurance premiums, into a deductible expense, the loan interest, because you strategically deploy the borrowed capital into a productive, government-incentivized activity.
It's the win-win structure again. The rule exists to encourage the productive use of that sheltered capital.
That's why it's there.
Let's run the numbers on the taxpayer payoff example for that strategy.
Let's do it. Imagine borrowing $100,000 against your CSV and using that $100,000 to purchase a rental duplex, a real estate investment.
Okay.
If the annual interest you pay back to the insurer is, say, $4,000, that $4,000 is now deductible as a rental expense against the duplex's income.
So if you are in a 40% tax bracket,
that deduction generates $1,600 in tax savings. Meanwhile, the original $100,000 CSV in your policy continues to grow, completely sheltered from tax. You've created an active, profitable, and tax-advantaged loop using one incentivized investment, insurance, to fuel another, real estate.
that is a phenomenal demonstration of turning a passive asset into an active, tax-advantaged investment tool. Let's shift gears to the final investment category, which is where most people begin and end their understanding of the tax code. Retirement savings.
The one everyone thinks they know.
The government purpose for retirement is fundamental, maintaining peace and order by ensuring the elderly are financially self-sufficient. You want to mitigate the need for massive social safety nets. But the book divides the retirement landscape into two distinct, fundamentally different paths.
And that distinction between qualified retirement plans, QRP, and non-qualified plans, NQP, is the single greatest differentiator between the average saver and the high-level strategic investor.
So QRPs are the familiar structures.
Your 401ks, traditional IRAs, employer-sponsored pensions. They're heavily publicized, highly regulated, they have rigid contribution limits, strict distribution rules, and they often restrict your investment choices.
And they are beloved by Wall Street because the money usually ends up flowing into publicly traded assets.
Almost always.
The primary benefit of a QRP is that you avoid the double tax on earnings.
Correct. You get a deduction on the money going in, and the money grows tax-deferred. The government just taxes you and the money comes out in retirement. This avoids that double taxation that occurs when you pay income tax on your salary and then pay capital gains or income tax on the annual earnings of that investment.
Okay, now for the non-qualified plans, the NQPs. This is where the true wealth builders play.
NQPs are strategic investments in those other 6 incentivized categories we've talked about: real estate, active business ownership, energy projects, agriculture, or insurance products.
And they are not subject to all those government limits.
No contribution limits, no required distribution rules. They can be structured strategically using partnerships, trusts, or specialized entities. And crucially, they can last for generations, passing wealth down without the rigid government controls that are applied to QRPs.
This directly correlates to what the book calls the financial IQ difference. If QRPs are easier, why take the more complex NQP path?
Well, QRP investment requires minimal financial IQ. You set your contribution rate, maybe you pick a target date fund, and you just wait.
Set it and forget it.
Pretty much. The NQP approach, however, requires a high financial IQ. You have to understand how to safely use leverage, how non-cash deductions like depreciation work, how to structure a business, and how to project long-term cash flow. But the complexity yields a reward that is significantly geometrically better.
We absolutely have to dive into the numerical comparison because this is the acid test. We are comparing a $25,000 investment annually over 30 years at a 6% compound annual return for both paths.
Okay, let's start with the qualified plan, the QRP. After 30 years, the account grows tax-deferred to $2,095,042.
A nice nest egg.
Very nice nest egg. When the investor retires, they typically liquidate this money over, say, 20 years. That withdrawal generates approximately $172,000 per year.
And they pay tax on that.
They pay ordinary income tax on that withdrawal. Assuming an effective rate around 19%, they're left with roughly $140,000 in net income annually.
But the major drawback, which is often overlooked, is that the principal is being steadily drawn down. Eventually, that fund runs out.
It's a depleting asset. It provides temporary, albeit large, income.
Okay. Now, compare that to the non-qualified path, using a strategic, leveraged real estate investment model.
With the NQP, the investor deploys that $25,000 per year, but they're prioritizing cash flow generation combined with maximized non-cash depreciation deductions. After 30 years, assuming a modest 3% annual appreciation on the assets, in addition to the cash flow.
Which is very conservative.
Very. The investor has gross assets valued at $6,843,032. The net equity, after accounting for the strategic leverage, is $3,363,032.
That's a difference of over $1.2 million in net equity compared to the QRP, and that's a conservative valuation.
That's significantly higher equity. But the true power is in the income stream. That portfolio provides an annual cash flow of $135,000.
Which is a little less than the QRP net income.
A little less, yes.
Yeah.
But crucially, due to the non-cash depreciation deductions that are constantly being generated, that $135,000 is often completely tax-free.
So the conceptual difference is that the QRP taxes the income you pull out, while the NQP shields the cash flow from taxation right from the start using these non-cash deductions.
That is it exactly. The NQP investor receives an annual income stream that is nearly as high as the net income from the QRP. But they achieve this without ever reducing their principal.
They've created a lifelong, non-depleting income stream.
And a nest egg of over $3.3 million in equity to leave to their heirs. The strategic NQP is overwhelmingly superior for building generational stability and wealth.
That high financial IQ is clearly the ultimate differentiator. Before we shift to the conclusion, let's briefly look at the policy implications of why the government promotes QRPs so vigorously, even if they aren't the most effective wealth-building tool for the individual.
It's because QRPs serve a vital economic stabilization function. Approximately 30% of all U.S. stock market investments come from qualified plans.
30%?
Because of mandatory payroll deductions and employer matching, this money is just constantly flowing into the market. As the population in these plans grow, they are perpetually required to invest new capital, which the author notes is like more money chasing the same amount of stock.
Which pushes prices up.
It supports stock market prices. And governments view sustained stock market growth and stability as a critical sign of economic health, which directly contributes to that core goal of keeping the peace. It's a mechanism for continuous economic confidence.
Okay, so we've covered the 7 massive incentivized categories: business, technology, real estate, energy, agriculture, insurance, and retirement. It's a comprehensive look at how the government signals its priorities. And now we get to the core insight, the unchanging truth of incentives.
The central truth is that political priorities, whether they're focused on economic growth or environmental change or social programs, they may shift based on the administration, but the mechanism never changes.
The tool stays the same.
The tool is always the same. Governments will always use the tax code as incentives because it's the most effective way to deploy private capital toward national goals. True priorities are manifested in tax laws, not necessarily in political rhetoric or campaign promises.
So the core strategic initiatives, energy, jobs, technology, housing, insurance, agriculture, retirement, they will always be in vogue.
Always. Because they address those 5 core needs of the nation that never go away.
And the common perception that tax laws are somehow inherently unfair or a burden on the average person is completely turned on its head here.
It really should be. Tax laws are described in the book as eminently fair because they apply equally to everyone who chooses to use them as intended.
You just have to know the rules of the game.
Exactly. The rich become rich, not by cheating or exploiting some accidental loopholes, because these benefits are intentional policy. They become rich by becoming active partners who align their capital with government priorities, legally reducing their tax burden while creating more income.
So the fundamental question shifts from, how do I pay less tax?
To the far more productive question, how do I strategically structure this investment to be deductible, productive, and aligned with national needs?
We have to finish with the ultimate payoff example, the bonus chapter strategy, the story of Brad Sumrock and the Ferrari. This anecdote just perfectly illustrates the ultimate payoff of becoming an active partner.
It's the perfect case study. Brad Sumrock, an investor and a client of the author, wanted a $285,000 Ferrari, but he operated under a specific mandate. He refused to pay tax on the money used to buy it.
That's a high bar.
A very high bar. A traditional approach would be saving up $95,000 for a down payment and then using new taxable earnings to cover the $42,000 annual loan payment. Brad took the strategic, active partner path instead.
Okay, walk us through the step-by-step math of how he leveraged the tax code to essentially get the car for free.
Instead of spending $285,000 on the car, Brad took that capital and invested it in a real estate syndication, an apartment building.
Housing, one of the core needs.
A core need. Because real estate is the most heavily incentivized investment, He immediately utilized bonus depreciation. His share of the first-year depreciation generated a massive $260,700 in deductions.
Wow.
Since he was in a combined 37% federal tax bracket, those deductions, combined with other minor deductions, resulted in a total first-year tax benefit of $103,119.
Wait, a tax benefit of over $100,000?
That's right.
And that completely covered his $95,000 down payment on the Ferrari with $8,000 left over.
The government effectively paid the down payment through the tax savings generated by his investment in providing housing.
That's the first win. But now he has a car payment.
Right. Next, he needed to cover the $42,000 annual car loan payment for the next 5 years. Well, the same real estate investment, the apartment building, generated $53,580 of annual cash flow for Brad.
So the investment not only funded the down payment through tax savings, but also generated enough cash flow and likely tax-free cash flow because of continued depreciation to pay the car loan entirely.
And then some. It is the absolute pinnacle of the win-win strategy.
Let's break down that win-win.
The government received stable, affordable housing, a core goal, and earned a solid 7.34% return on its investment, which was the tax benefit it provided.
And the taxpayer.
The taxpayer, Brad, obtained a luxury asset and, crucially, retained a cash-flowing, appreciating asset in the real estate syndication. The strategic investor understands that the investment itself, by aligning with government goals, should fund the lifestyle, not the labor.
The ultimate lesson here is that investing strategically in government-incentivized activities creates exponentially more income and dramatically less tax liability than merely relying on traditional employment income.
Absolutely. The game completely changes when you recognize that the wealthy aren't avoiding tax. They are fulfilling the government's stated mandate for capital deployment. They maximize their income by operating within the rules that were designed to encourage capital to flow into socially and economically beneficial activities.
This entire deep dive has just brilliantly synthesized the material and reframed the relationship between the taxpayer and the government as a business partnership.
An active and a highly profitable partnership. And the opportunity is open to everyone who is willing to gain the financial IQ needed to play the game.
What a deep dive this has been, completing our journey through the win-win wealth strategy. The core takeaway from this entire strategy is that wealth creation is fundamentally about strategic partnership.
Okay.
It's about aligning your capital with the fundamental needs of the government, whether that's housing, food, energy independence, security, or retirement stability.
So if you are looking to adopt this strategic perspective, your first steps are pretty clear. Review your current portfolio, determine which of these 7 incentivized areas, business, technology, real estate, energy, agriculture, insurance, or retirement, fits your long-term goals.
And then find the right team.
And then make sure you find a tax advisor who doesn't just manage your compliance, but who understands how to use the tax code as a proactive investment tool.
And the final provocative thought we want to leave you with is this. The ultimate goal here isn't simply reducing your tax burden this year. It is building generational, self-sustaining, tax-free wealth, a feat that is only achievable when you stop being a passive, silent taxpayer and you start being an active, strategic partner in the game. Thank you for watching. Please like, share, subscribe, follow up in next video.